Hello, everyone. This is Dr. Naser Makarem from the University of Aberdeen. I am an assistant uh, professor in accounting, and it's a pleasure uh, to present a keynote speech for the conference. So today, what I'm going to present is a paper on the role of financing decisions in earnings discontinuities. So this is the outline of what I'm going to present. I firstly present an introduction about the evidence of discontinuities. Then I will do a review of the literature and basically a systematic review of the literature. Um, then I will present research methodology and findings, following by concluding remarks. Uh, so let's start with evidence of earnings discontinuities. The first author to recognize and report a discontinuity in the distribution of earnings is Hain, 1985. She plotted distribution of earnings per share um, to price ratio for the period 1963 to 1990, and she found a point of discontinuity around zero, and she attributed this discontinuity to earnings management. This is from her paper, 1995. You can see there is a clear point of discontinuity just at zero earnings. You see there are too many observations just below zero, and too high frequency of observations just above zero. But the seminal paper in this area is Berger-Starrell and Dichev, 1997. They plotted the distribution of annual net income and changes in annual net income, both scaled by lagged market value for the period 1977 to 1994, and uh, they observed the same discontinuity reported by in 1985. So what they did was that they plotted the distribution of earnings, and in their distribution, what they expected was to see a smooth distribution. So in absence of earnings management, they expected to see a bell-shaped, smooth distribution. And how they operationalized the smoothness was to look at the intervals, earnings intervals. The expected frequency in each interval was expected to be the mean of the frequency of its two neighboring intervals. And as I mentioned, they found a point of discontinuity with too many observations reporting a small profit and too few reporting a small loss. And they attributed it to earnings management to avoid losses and earnings decreases. So this is taken from Berger and Dichev, 1997. As you can see, there is a point of discontinuity just at zero earnings. And you see there are lots of observations just reporting a small profit, and too few observations reporting a small loss. Um, Other papers also provided evidence in support of this earnings management explanation of the discontinuities. For instance, Beaver et al. 2003 showed that insurers with a small profit understate their loss reserves relative to those with a small loss. Also, Jacob and Jorgensen, 2007, they showed that earnings distribution of fiscal year has stronger discontinuity compared to quarterly periods. And also Donaldson et al. 2013, they showed that discontinuity around zero earnings is weaker for the restated or unmanaged earnings compared to managed or original reported earnings. But there are some evidence against earnings management explanation as well, and that's why the objective of this study is to examine whether earnings management is responsible for earnings discontinuities. So to start with, we did a literature review, a systematic literature review on earnings discontinuities. So we started with 27 3 and 4-star accounting journals based on 2021 Chartered Association of Business Schools journal ranking. So what we did was to search Scopus database for 1997 to 2022. And the reason why we started with 1997 is that the seminal paper in this area, which is Bergstaller and Dichep, was published in 1997. We found 287 research manuscripts, and we removed those that do not represent an original contribution, for example, discussion papers, review papers. And we also removed papers that are not related to our research question. So our research question is whether earnings management is responsible for discontinuities. So we removed 108 further outputs. For instance, papers doing a regression, a discontinuity regression, and other irrelevant papers have been removed. So the final sample is 171 papers. So when we looked at all the papers, start with reading the abstracts and introduction. And just by looking at the abstract and introduction, we managed to separate the entire literature into two main strands. One is the first strand uses discontinuities as a proxy for earnings management, and that is more prevalent, as you can see in the chart as well. And also, the second strand is the one that seeks an explanation for discontinuities, and that's the focus of our study here as well. So those studies using discontinuities as proxy for earnings management are far more frequent than studies actually seeking an explanation or examining earnings management explanation. We further looked at the frequency of earnings benchmark studied in the literature. So the main benchmarks used in the literature are zero earnings, analyst forecast, and last year earnings. And as you can see here, when we look at the two strands that I just mentioned, those using discontinuities as a proxy for earnings management are focused on analyst forecasts only, and then a mixture of the three main benchmarks. And when you look at the studies seeking an explanation for discontinuities, you see that overwhelming majority of them are looking at zero earnings only, and then a mixture of the three earnings benchmarks. So uh, they're not these two strands are different in terms of their focus on the earnings benchmarks. So this chart shows you the development of the literature on discontinuities. So since the evidence on earnings discontinuities, as I mentioned, the literature has gone in two ways. One way is to use this earnings discontinuities, assuming that discontinuities indicate earnings management. And the second strand, which is the focus on of our study, is the one seeking an explanation for earnings discontinuities. And under this one, there are two distinct group of studies. The first one is supporting earnings management explanation, EME. Um, how do they do that? They provide evidence consistent with earnings management explanation in different settings, and also they try to refute alternative explanations. But there is another strand of literature opposing earnings management explanation by providing alternative explanations like tax, special items, sample selection, and scaling. I will discuss this in this presentation later on. And uh, also refuting assumptions behind earnings management explanation. So based on the studies supporting earnings management explanation, we can conceptualize this explanation. So the main claim under earnings management explanation is that discontinuities in earnings distributions are caused by earnings management. And further, we can divide or break this down into to some subclaims. The first one is firms trying to meet earnings benchmarks. This is supported by prospect theory. The second one is meeting earnings benchmark is achieved through earnings management. This one is supported by agency theory. And the third one is that benchmark meeting earnings management creates discontinuities in earnings distributions. And this one is based on two strong assumptions. The first assumption is that the distribution of earnings would be symmetric in the absence of earnings management. So um, we expect no discontinuity if there is no earnings management. And the second assumption is that an earnings discontinuity is created by firms that would otherwise miss an earnings merit benchmark, managing their earnings upward to meet the benchmark. So basically, if you consider, if you just assume zero earnings, what this assumption says is that firms that would otherwise report a small loss have used earnings management to shift to a small profit. But as I mentioned, there are some evidence against earnings management explanation. So this explanation is under this assumption that small profit firms and small loss firms are different in terms of their earnings management behavior. So what we expect is that small profit firms should be involved in upward earnings management compared to small loss firms. So there is evidence against this assumption. Dicho et al. 2003 showed that the discretionary accruals of small profit firms and small loss firms are the same. And also Makarem et al. 2018 showed that the real activities manipulation of small profit firms and small loss firms are also the same, which is inconsistent with the assumption that I just mentioned. So as I mentioned, some studies try to provide alternative explanations because earnings management explanation um, it could not be supported. Durci and Easton, in two separate papers published in 2005 and 2009, they showed that research design choices contribute to the kink. uh, they showed that scaling can contribute to the kink or the discontinuity. So if the deflator used varies across observations to the right of zero and those to the left, deflation will create a gap in the distribution. They also showed that sample selection criteria lead to differential inclusion and exclusion of observations to the right and left of zero. So that creates a gap in the distribution of earnings. And also they showed that the difference between profit and loss observations can contribute to the kink. So they particularly showed that analysts' forecast errors are much greater when they are optimistic than when they are pessimistic, which contributes to the kink around analyst forecast errors. Also, Beaver et al. 2007, they showed that asymmetric nature of some earnings components contribute to the kink. They particularly showed that higher tax rates for profit firms push them towards the interval to the right of zero, and negative special item push loss firms away from zero. And when you consider the combination of these two effects, that will create a kink in the distribution of earnings. But recently, in 2015, there was this paper by Gilliam et al. That showed that discontinuities around zero earnings um, have disappeared after Sarbanes-Oxley Act. And also, Makarem et al. 2018 showed that the same discontinuity around last year earnings has also disappeared. So what are the implications of these findings? They undermine the main empirical observations supporting the earnings management explanation, which is obviously the existence of the kink. And also they call into question alternative explanations because alternative explanations predict um, uh, a point of discontinuity around earnings benchmarks. This is taken from Gilliam et al. 2015. As you can see in figure A, you can see there is a point of discontinuity. This one belongs to the pre-SOX period. And when you look at the figure B, you see there is no point of discontinuity. This one belongs to post-SOX period. So so we've seen that the literature suggests that earnings management may not be responsible for earnings discontinuities. So what we're going to do is to look at the data here to see whether we can find another explanation for discontinuities. So we used composite data for 1976 till 2015. We removed regulated and financial industries, and um, we also removed observations with exactly zero earnings. The final sample includes more than 210,000 observations, and we use distribution of earnings and standardized differences to test for discontinuities. So here you see the distribution of net income before and after SOX. So you see before SOX, there is a clear point of discontinuity. And just like what Gilliam et al. Reported, there is no point of discontinuity after SOX. When we look at special items, so we compare income before special items for the pre and post 2002 periods. You see that in the pre 2002 period, there is still a point of discontinuity for income before special items, but there is no discontinuity after 2002. So that suggests that special items cannot explain the discontinuities. We also did the same thing for income before tax. So we see the distribution of net income before tax pre 2002 and post 2002. And again, for the pre 2002, there is no discontinuity, while after 2002, sorry, for the pre 2002, there is a clear discontinuity, while after 2002, there is no discontinuity in the distribution of income before tax. But then we look at income before interest, and that is the interesting observation we made. So as you can see, for both pre and post 2002, there is no discontinuity in the distribution of net income before interest, which suggests that interest expense may explain discontinuities in reported earnings. So to understand why interest expense and how interest expense can explain discontinuities, we looked at the financing decisions, because interest expense is a reflection of financing decisions. So we looked at financing behavior of firms before and after SOX to see if there's been any shift, and the literature says yes, there is a shift in the financing behavior of firms after SOX, as reported by Carter 2013, as firms take more debt after SOX. And there's also evidence that evidence of a discontinuity around zero earnings in the issuance of debt, with the small loss firms issuing significantly lower debt than small profit firms. We also looked at the discontinuity using a very novel method, which is regression-based and suggested by Bizzalo and Bosu 2019. So this is basically a two-stage OLS procedure. The first stage estimates the pre-managed earnings distribution, and the second stage estimates the probability of meet or beat behavior. So what we did was that we ran Bizzalo and Basu's tests separately for the pre and post 2002 and compare the results. So this is what we got for interest expense. So the variable of interest is the interaction between pi and interest expense. So, but before that, pi itself shows the existence of discontinuity. So as you can see, the coefficient on pi is positive and significant for the pre-2002 and insignificant in the post-2002 period, which further shows the disappearance of the discontinuity after SOX. But as I mentioned, the variable of interest is the interaction between pi and interest expense. As you can see, it is marginally significant before 2002, but very insignificant after 2002, which further supports our explanation that financing decisions contributed to the discontinuity. We also looked at the weighted average cost of capital for the pre and post SOX periods. As you can see, there is a shift. So again, the variable of interest is the interaction between pi and weighted average cost of capital. As you can see, the coefficient is positive and significant pre-2002 and negative and significant in the post-2002 period, which is consistent with the shift in the financing behavior of firms. So basically, what we've done here is to compare the periods of existence and disappearance of the king. And our main takeaway is that we revealed the contributing role of interest expense, which denotes financing decisions. We also, in untabulated results, we also showed that coincident with the disappearance of zero earnings discontinuity, pre-SOX discontinuity in the distribution of debt issuance has also disappeared, which is another evidence of a shift in the financing decisions after SOX. So what we suggest is that earnings management through financing activities manipulation can explain the discontinuity in the distribution of earnings. So basically what we showed is that a shift in the financing decisions is responsible for the discontinuities. Thank you very much for your attention.